Good day, and thank you for joining the National Conference of State Legislatures and the Pew Charitable Trusts for this webinar entitled Approaches to Considering Proposed Tax Incentives. My name is Emily Mayer, and I am a Policy Associate in the Fiscal Affairs Program at the National Conference of State Legislatures. I will be serving as today's moderator, or one of today's moderators. As a reminder, if at any time during this webinar you have any difficulty hearing the audio through your computer speakers, please use your telephone to dial in for the audio portion. The webinar will be recorded and archived. You can also download a PDF version of today's webinar slide deck at the top right tab above the PowerPoint. Please stick around after the webinar concludes for a brief survey. The National Conference of State Legislatures is pleased to partner with the Pew Charitable Trusts to bring this webinar to you. In case you are not familiar with NCSL, we are a bipartisan organization that serves the legislators and legislative staffs of the nation's 50 states, its commonwealths, and territories. Our mission is to strengthen state legislatures. NCSL provides several different services, including research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. This December, we are hosting our annual Capitol Forum, December 10th through the 12th, in Phoenix, Arizona. The forum is an opportunity for members to help develop the state's agenda, get context and analysis on critical issues facing state legislatures, and network with legislators and legislative staff from around the country. Tax incentives fall primarily within the jurisdiction of NCSL's Standing Committee on Labor and Economic Development. NCSL's standing committees provide a forum for legislators and legislative staff to exchange ideas and shape public policy. They meet twice a year at the NCSL Legislative Summit and Capitol Forum. For more information on these meetings or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. This jointly sponsored webinar will look at practices that can guide economic development tax incentive considerations. We'll start with an overview of the topic by Pew expert Khara Boender. Khara is a senior associate on the tax incentives team for the Pew Charitable Trusts. Khara earned her bachelor's degree in political science from Loyola University, Maryland. Then we'll hear from Jeff Mitchell of Washington and Don Iglesias of New Mexico, who will discuss incentive considerations in their respective states. Jeff is a senior fiscal counsel of the Washington Senate Ways and Means Committee. He has worked as a staff attorney for the Washington State Legislature in various capacities for over 20 years, specializing in state and local government finance issues. Dawn is the chief economist for the Legislative Finance Committee in New Mexico, where her primary roles are projecting state revenues and estimating impacts of tax policy changes. Dawn holds a Master of Public Administration and Master of Arts in Economics from New Mexico State University. After we hear from our presenters, we will open the discussion to include questions from the audience. To ask questions, you can simply type a question in the Q&A box in the right-hand corner of your screen. We will take as many questions as possible within the time we have available. Now I will turn the program over to Khara. Welcome, Khara.
Thank you, Emily. Good afternoon, and thank you to all joining us today. My name is Khara Boender, and I'm a Senior Associate on the Tax Incentives Team for the Pew Charitable Trust State Fiscal Health Project. The Pew Charitable Trust is a nonpartisan, nonprofit research and public policy organization dedicated to serving the public interest. Through both research and technical assistance, Pew's state and local government performance portfolio helps states and localities develop and adopt evidence-based policies that are proven to work on issues ranging from building a strong fiscal foundation to protecting public safety and health. During today's webinar, we will discuss ways states can evaluate proposed tax incentives. When policymakers consider new tax incentives, they face hard choices. Subtle differences in design can really impact whether programs effectively achieve their goals. Some states have explored approaches to help lawmakers tackle these decisions. One option is to establish principles for designing tax incentives. With this approach, lawmakers can agree on general principles for incentive programs, establishing rules for creation and design. Then they should assess the extent to which the proposals adhere to these principles. Another option is for states to develop procedures to consider proposed incentives in a deliberative manner. These procedures help ensure that staff members have adequate time to conduct fiscal analyses or that proposals are accompanied by specific information to help lawmakers decide on their value. And third, states can conduct upfront analysis of proposed incentives to forecast their effectiveness. These formal studies help assess proposals' design and likely results. Some of these studies focus on the largest proposed incentives rather than analyzing every bill in depth. As policymakers consider whether to approve or make adjustments to the design of proposed incentive programs, there are several questions that can help them to decide which actions to take. These questions are, is there a clear rationale for the program? Is the incentive designed to achieve its stated goal? Does it minimize negative economic impacts? Does it include fiscal protections? Is it structured to be adequately and efficiently administered? Is the tax incentive designed to facilitate evaluation? I will briefly go over a few examples from Arkansas, Maine, and Virginia. Our two panelists, Don Iglesias and Jeff Mitchell, will talk about their respective experiences in New Mexico and Washington. Arkansas is one example of a state that has conducted upfront analysis to inform lawmakers' decisions. Under one incentive program created in 2004, the Arkansas Development Finance Authority is authorized to issue bonds to help secure large-scale private sector investments. These potentially costly deals require legislative approval, and to inform these decisions, state law empowers the Senate President or Speaker of the House to contract for a cost-benefit analysis on incentive deals. Bonds have been issued under this program only once in 2013 to attract the Big River Steel facility to northeastern Arkansas. Legislative leaders contracted with two consulting firms to assess the project. One analysis vetted the executive branch's economic assessment, providing information to help lawmakers decide on the project's merits. It also assessed whether the steel plant would be economically viable, considering national competition. Maine similarly opted to conduct an upfront analysis of a newly proposed program. In 2017, Maine lawmakers approved an incentive to encourage business headquarters to locate in the state. However, they delayed implementing the program until 2020 to give the state's Office of Program Evaluation and Government Accountability time to evaluate the program's design. The study provided lawmakers with information that helped inform amendments to the program before it went into effect. Based on the findings, lawmakers strengthened business reporting requirements and clarified the process for recapturing credits when necessary. In Virginia, the approach is a bit different. The Senate Finance Committee sets principles for how it considers tax credits. For example, all tax credits should expire after 5 years unless renewed, and cash grants are preferred over refundable or transferable credits. The Senate Finance Committee also adopted procedures designed to ensure that lawmakers have high-quality information on the expected cost of any proposed credit before they vote. For instance, votes on tax credit bills are scheduled during the final week of committee action on legislation. This approach maximizes the time available for professional staff to analyze fiscal impact. Designing effective programs can be complex. However, there are tools that policymakers can use to help inform design, administration, and execution decisions for economic development programs. I will now turn it over to Jeff Mitchell from the Washington State Senate Ways and Means Committee.
Okay, thank you. So before diving into the primary purpose of my presentation, which is to discuss Washington State's upfront consideration of tax incentives, I thought it is probably useful to briefly mention Washington's tax structure, since we are a bit of an outlier compared with other states. So Washington is an excise tax state, deriving most of its revenue from a general sales tax and gross receipts business taxes. Washington is one of 7 states with no individual income tax and one of 4 states with no corporate net income tax. So you'll notice the stark difference in the state tax composition as an example of Oregon by looking at Oregon and Washington, which despite their proximity have completely different structures. Oregon is in the top quartile in terms of income tax revenues as a percentage of total tax revenues at 77%, but has no general sales tax. And then Washington, on the other hand, has no income tax, but then relies on sales taxes and gross receipts business taxes for about 76% of its tax revenues. So now in terms of some brief background on Washington's existing tax incentives. So the first thing I want to mention is terminology. In Washington, tax preferences are specifically defined in statute to mean tax credits, tax exemptions, tax deductions, preferential tax rates, and it can apply to tax relief for both businesses as well as individuals. So depending on the context throughout my presentation, I use these terms just interchangeably, but please keep in mind that tax preferences is a broader term than tax incentives. So Washington has about 744 tax preferences currently on the books. The chart on top shows the number of tax preferences enacted by a year, and the bottom chart shows the cumulative total by decade. So a couple highlights. So first of all, Washington's excise tax structure was first put in place in 1935. And from a broad structural standpoint, it's largely unchanged since then. At the time of its creation, there were 44 tax preferences that were included as part of that original enactment that were, I think, are generally considered part of the underlying tax structure. And then, as you can see, decade by decade, the number of tax preferences enacted is generally growing through the 2000s. I would note that probably beginning in the mid-1980s and then definitely by the 1990s, economic development tax incentives became more common. So, and then for the current decade, there have definitely been fewer tax preferences that have been enacted, and I think there's two primary reasons. First of all, the recession, and then second of all, Washington also had some significant budget challenges due to a K-12 funding mandate due to a state Supreme Court decision. Okay, so this slide captures the main considerations related to tax incentives in Washington. I will be talking about a number of elements reflected on this slide in more detail in later slides, but I wanted to capture the major elements in one place. So the upfront consideration of tax incentives in Washington can be viewed as two distinct processes. The first process is acquiring background data or information regarding the issue, driving the request, the proposed economic outcomes, and then the fiscal and budget impacts to the state. And then the second broad process uses this information to develop the specific elements to be incorporated into the tax incentive legislation. So this would be the specific public policy objectives, metrics to evaluate the effectiveness of the program, potential expiration dates, fiscal caps, etc. So briefly touching on the elements in the first part that relates to acquiring basic data or information for a tax incentive proposal. An obvious source of initial information regarding the issue and the potential economic outcomes will be the bill proponents. So, for example, proponents may approach the legislature outlining the possibility of a firm opening a facility that would employ 500 people. However, the proponents have expressed a concern that Washington's tax structure is not competitive. So if the legislature decides to move forward with legislation to address the concern, this economic outcome could be codified into the bill to measure the success of the program. So in other words, the stated goal of employing 500 people could be a target specifically built into the bill. Contextual data. Oftentimes, we research external data to provide additional insight into the nature and the scope of the issue. And to be clear, this is usually to try to shed light on a fundamental question to which we rarely know the answer with any certainty, which is whether the tax incentive is actually going to make a material impact on the decision of the business. So we will oftentimes look at what is the tax treatment of this activity in other states. Is there something that is making Washington substantially uncompetitive? Does the industry already have a presence in Washington? If so, how has it changed? What are the wage levels in the industry, or a couple of examples. Fiscal notes. They are a very important piece of information for legislators when evaluating a new tax incentive. They allow legislators to weigh the fiscal impact in relation to proposed economic benefits. We will talk more about Washington's fiscal notes on the next slide. 4-year budget outlook. So budget writers, as part of any budget proposal, include a 4-year budget outlook. The revenue impacts are reflected on fiscal notes, are incorporated into a 4-year budget outlook that balances anticipated revenues and anticipated expenditures under the budget proposal over a 4-year period. We'll also talk a little bit more about this in a future slide. Tax preference performance reviews. So Washington, about 13 years ago, adopted a process to review most tax preferences over a 10-year period. For an existing tax incentive up for reconsideration because its expiration date is approaching, as an example, the information and recommendations from the review will be very important for the legislators when considering the proposal and potentially extending it. Now, turning to the second general process regarding the consideration of what elements, requirements, and conditions to include in the tax incentive legislation. We will also be talking about several of these in more detail, but as a quick outline, in 2013, Washington enacted legislation that requires bills creating new tax preferences to be very descriptive regarding public policy objectives and how to evaluate them. These are referred to as tax preference performance statements. That same 2013 legislation also created an automatic 10-year expiration date for tax preferences if the legislation does not specify an alternate date. Also, businesses claiming economic development tax incentives are required to file annual reports detailing wages, employment, and the amount of tax savings for the prior year. These reports are also generally subject to public disclosure. And then the fourth bullet, while not required, some tax incentive bills do incorporate firm-level employment and wage requirements with some type of clawback provision. And then lastly, it is fairly common for legislation to limit the fiscal exposure to the state by including some type of statewide fiscal cap. So for the rest of my presentation, I am going to elaborate on several of the elements that I mentioned on the prior slide. So like most states, Washington produces fiscal notes reflecting the estimated expenditure and revenue impacts of legislation. For new tax preferences, I think it is a primary informational tool that allows the legislature to measure the proposed fiscal impact on the state against the purported economic benefits from the legislation. Most of you are probably familiar with fiscal notes, but I'll quickly mention that overall I think Washington does a good job with respect to its fiscal note practices. So first of all, they're prepared for substantially all bills. They reflect revenue and expenditure impacts over 3 biennia. So for example, if the fiscal note only included a 2-year time frame, many tax-related bills, as well as other types of legislation, often have delayed implementation dates, and so the fiscal cost may not be reflected on the fiscal note. However, under a 6-year time frame, the probability is a lot higher that the full annual cost of the tax incentive will be reflected for at least 1 or 2 years on the fiscal note. And then they are revised continuously during the legislative process to reflect changes in the legislation. And this is really important because oftentimes we specifically make changes to bills at the request of legislators to accommodate or make changes to their fiscal impact. And then lastly, fiscal notes are available to the public. So fiscal notes for tax incentives are also important because four-year budget outlook documents are also created for any budget proposal. The outlook document reflects the anticipated revenues and expenditures under the proposal. To be clear, the actual budget itself is a two-year budget, but the outlook document goes out another 2 years. This four-year budget outlook requirement was enacted in 2012. The outlook document captures not only the proposed expenditures, but also changes to estimated revenue from the tax legislation that is assumed as part of the budget proposal, including bills establishing tax preferences. So first, I will quickly mention that the example on this slide includes 6 years due to the fact that the recently concluded 2017-19 biennium is also included, and then plus the 4-year period applicable to the new 2019-21 biennial budget. I've highlighted a couple rows. So first, Washington gets a quarterly revenue forecast from its Economic and Revenue Forecast Council, which is reflected on the orange highlighted row. And then the light green highlighted row is where the assumed revenue legislation is reflected. In this particular instance, the net impact from about 10 to 15 revenue bills is reflected on the row. And then the row in red shows the total revenues and resources that are available. And then there is another half of this document detailing the expenditure side, which was not included for purposes of readability. So legislation enacted in 2006 mandated performance reviews of Washington's tax preferences over 10 years by Washington's Joint Legislative Audit and Review Committee, referred to as JLARC. The legislation outlines specific questions to be answered by JLARC, which primarily focuses on whether the tax preference has achieved its public policy objectives. The 2006 legislation also created a citizen commission for performance measurement of tax preferences that has the primary duty of determining which tax preferences will be reviewed each year. The process generally includes the citizen commission setting the review schedule for the following year, and then JLARC staff independently conducts the reviews in accordance with generally accepted auditing standards, and then JLARC will make a recommendation to continue, modify, or terminate the tax preference. And then the Citizen Commission takes testimony and adds comments to the JLARC report, but they're not allowed to modify it. And then the legislature will then hold a public hearing during the next legislative session and may take action based on the JLARC recommendations. Certain issues became apparent as JLARC began conducting tax preference reviews over a decade ago. To outline some of the more significant issues, legislative intent was often missing, making it difficult to determine the public policy objective. This was especially true for tax preferences enacted before the 1990s. Even if there was legislative intent, it was often unclear or overly broad or lacked a targeted outcome. You know, for example, if the bill specifies that the public policy objective, is to create quality jobs, well, I mean, how many jobs and what are the wage levels, et cetera. And then also there was often a lack of data. In other words, the metrics to evaluate the tax incentive could be completely clear, but if there's no data available to actually perform the analysis, then it's obviously very difficult as well. So in 2013, to address these concerns, legislation was enacted that required all future tax preferences to include a tax preference performance statement. So the goal of a tax preference performance statement is to lay out in detail the public policy objectives for a tax preference, the metrics that will be used to evaluate whether the tax preference has been successful in meeting the public policy objective, and then the data sources to do the analysis. The other big component of the 2013 legislation is that it creates an automatic 10-year expiration date for tax preferences unless an alternate date is provided in the legislation for the new tax preference. And then furthermore, with respect to economic development tax incentives, there is also a requirement that taxpayers must file an annual report detailing employment, wages, and savings from the tax incentive. Okay, so this slide provides an example of a tax preference performance statement that was created in 2017. I will highlight a couple components. So first, subsection 3 lays out the public policy objective of maintaining and growing jobs in the semiconductor cluster in Washington. This by itself is a little vague. However, looking at subsection 4, it is very specific in terms of how to measure the success of the incentive. So first, at least one project must be located in a specific county, generating at least 2,500 jobs that pay a specific amount. And then second, the number of jobs in the semiconductor cluster in Washington must increase overall. Subsection 5 then specifies that the data to do the analysis in subsection 4 will come from the annual survey submitted by taxpayers claiming the incentive. So my final slide is the section of law that creates the substantive tax preference for the semiconductor tax incentive. It also contains some firm-level eligibility requirements to claim the tax preference. These firm-level requirements are definitely more of the exception in Washington. So just quickly walking through the statute, subsection 1 establishes the preferential tax rate. Subsection 3 is the language that requires a taxpayer claiming the preferential tax rate to file an annual report detailing wages, employment, and tax savings. Again, this will provide the information that JLARC on the prior slide will use in part to evaluate the tax preference. And then subsection 4A sets specific firm-level employment requirements. In this case, a business claiming the tax incentive must maintain a certain employment level, or it will have to pay back a portion of the tax savings. And then subsection 5 establishes the expiration date for the tax preference, which in this case is 2028. And to close the loop on that, so then JLARC, I believe it would be 2 years before the actual expiration date, they will go through and do their analysis of the tax preference and provide their analysis and the recommendations to the legislature, and then that gives the legislature 2 sessions to evaluate the analysis provided by JLARC when considering whether to potentially extend the tax preference. So with that, I conclude my remarks.
Great, thanks, Jeff. And now I will get started discussing the tax expenditure policy principles that our New Mexico Legislative Finance Committee recently adopted to evaluate any proposed new or expanded tax incentives. First, I'm going to give a little bit of background. So, for years, the staff of the New Mexico Legislative Finance Committee used several established tax policy principles as a guide when evaluating any existing or proposed policies. These principles were officially adopted by our Legislative Finance Committee and then used in any of LFC's policy analysis for over a decade. Just to briefly review them, the principles cover that of revenue adequacy to fund government services, efficiency, that taxes should have broad bases, low rates, and spreading the reliance over a variety of taxes. Taxpayers should be treated fairly and equitably. Taxes should be simple, easy to collect, easy to understand, and that they should be accountable, easy to monitor, and easy to evaluate. However, some runaway costs of recent tax expenditures showed us that we really needed additional policy principles when looking specifically at tax expenditures. And I'll give an example of this as our high wage jobs tax credit. This is an economic development incentive that is eligible for eligible employers who create high wage economic based jobs in New Mexico. And the cost of this incentive went from about $10 million total in fiscal year 11 to about $63 million refunded by fiscal year 16. And part of the reason for the significant increase in the cost of this credit was following some amendments that were made in 2013, which, among other things, made some definitional changes, changes to the parameters in which the credit could be claimed, but there were some unintended consequences of those changes. One, it allowed taxpayers to file for multiple qualifying periods all at once, so the state experienced cumulative costs hit in a single fiscal year for claims over multiple years. It also allowed for unintended recipients of the credit, namely oil and gas companies in the state, and it also allowed employee benefits to be included in the wage calculation. So this led to a significant increase in the costs, and as the state was undergoing solvency efforts in 2016 due to the oil price crash and a significant serious downturn in our state revenues, the legislature significantly narrowed the eligibility requirements for this credit in a special session held in 2016. And I'll actually review this credit a little more to come as some changes were also made in the 2019 session. But following this, we really realized that we needed additional policy principles specifically to deal with tax incentives. And our LFC set out to create those principles. The effort was spearheaded by our former chief economist, John Clark, who's now the cabinet secretary of New Mexico's Economic Development Department. And he created these principles based on prior experience in economic development and in consultation with other experts in the field. So I'll go over these principles now. The first is that tax expenditures should be vetted. This means that any proposed new or expanded expenditures should be reviewed by interim legislative committees and their staff. That includes our Legislative Finance Committee or our Interim Revenue Stabilization and Tax Policy Committee. And this is to look at the legal, fiscal, and policy parameters. And really it's to prevent any rushed or limited evaluations mid-session, where analysts often only have a few weeks or maybe even a few days to evaluate a proposal. Next, the incentives should be targeted, where the tax expenditure has a clearly stated purpose, long-term goals, and measurable annual targets designed that are to mark the progress toward those goals. And this is so we can know what it is that the incentive is trying to do and why. Next, that tax incentives should be transparent. Data on the incentive should be collected regularly. This includes data from recipients who should report to our tax department or our economic development department, or in some cases even our workforce solutions department. And in turn, those departments should be required to report the data that they collect on an aggregate basis to the legislature on a regular annual basis. Next, incentives should be accountable. In this principle, this means that the data that's collected should be sufficient for public analysis, meaning it should help determine the progress toward the goals and determine the effectiveness and efficiency of the tax expenditure. And included in this accountability principle is a set expiration date. And this is to allow for the legislature to have a scheduled review of the tax incentive to make sure that it's doing what it's intended to do and that it's working well, or give the legislature a chance to revise it or let it expire if it's not doing what it's intended to do. Along that same token, then, tax incentives should be effective. They should fulfill their stated purpose. If it's designed to alter behavior, for example, if an economic development incentive is intended to increase economic growth or create jobs, then there should be indicators that this is actually happening, and indicators that the recipients would not have performed the desired actions but for the existence of the incentive. Otherwise, the legislature is simply rewarding activity that would have occurred anyway. And the last policy is that tax expenditures should be efficient. It should be the most cost-effective way to achieve the desired results. And really, this is a determination of whether it's the best use of taxpayer dollars. These tax expenditure policy principles were officially adopted by our Legislative Finance Committee in October of 2018, and our legislative staff used these principles in the upfront evaluation of any tax expenditure bills in both the 2018 and 2019 legislative sessions. When our committee adopted these principles, they did so with minimal debate. And additionally, when some tax expenditures are created, it's difficult to really determine a cost for them, but for those where it was clear that the cost would likely be significant, our committee also adopted official language to go in all of our fiscal impact reports that are created on every bill introduced during a session. And included in this standard language is a recommendation by the committee that if the policy principles of vetting, targeting, and reporting are not met, then the bill should be held for future consideration in order to give time for adequate review. We also reviewed these principles with our interim committee for revenue stabilization and tax policy. However, that committee was unable to officially adopt or endorse the policy principles because they lacked the statutory authority to do so. However, we are consistently working with both this committee, both the Legislative Finance Committee and the Revenue Stabilization Committee, in making sure that they're aware of the tax policy principles and are able to use them to evaluate any new incentive bills. For this purpose, we created an easy visual for all of our legislators to be included in each of the fiscal impact reports for any tax incentive proposal. And it has check marks to indicate if a specific policy principle has been met, an X if it clearly has not been met, and then a question mark when that is unclear, and options for adding brief comments to explain the rating that we've assigned to each of these bills. I'll give a few examples of how this has been used in our recent 2018 and 2019 legislative sessions. And one is coming back to modifications to the high wage jobs tax credit. Additional modifications were made to this credit in 2019 in the recent legislative session. It was determined that the 2016 special session changes were too restrictive, making the credit almost unusable by most businesses. So in 2019, they expanded the eligibility again and extended the sunset date, where the eligibility requirements were still more restrictive than when the cost had escalated. And the estimated impact of this legislation was about $10 million per year. And when we look at how it rated against our tax expenditure principles, there was discussion during interim committees, so the proposal was vetted, and in this process, LFC staff was able to get some of the most up-to-date data on the usage of this credit to allow for better cost estimates in the fiscal impact reports, and a significant amount of the debate regarding the changes to this credit, both in our finance committees on the House and Senate side and the debate on the floor of the House and Senate, regarded whether or not this proposal had been vetted through our legislative staff and through our committees. So there was increased awareness regarding whether or not this had been reviewed, and increased awareness of the policy principles. The credit does also have a sunset date, so it meets that requirement. The sunset date was extended in the recent session to 2029, so 10 years out. However, it did not have a clearly stated purpose, although unlike many of the tax expenditures, this one seems relatively clear to incentivize the creation of high-wage jobs. But there were no long-term goals or measurable targets included. And additionally, the original legislation and the bill proposal did not include any additional reporting requirements to the legislature or additional reporting by the taxpayer to our tax department. Now, as a credit, they do have to report to the tax department how much is claimed in the credit, but there's no required reporting from the department to the legislature on how it is used or how many jobs are created. Despite the ratings, if we see how it fared up, the bill did pass the House and Senate unanimously, and it was signed into law following the session. Another bill that was introduced was a foster youth employment tax credit. Now, this is not an economic development incentive, but it is a tax incentive that was intended to incentivize the employment of current and former foster youth in the state. It allows employers to claim a $1,000 credit against their personal or corporate income tax for employing a qualified foster youth. And it did have a low annual estimated cost, and we looked at how it fared against the tax policy principles. The bill did contain a stated purpose, and it did have some reporting requirements. The taxpayer was required to report the amount of the credit claim to the tax department, and the tax department is required to present the number of taxpayers approved for the credit, the aggregate amount of the credit claimed, and a broad requirement for, quote, any other information necessary to evaluate the effectiveness of the credit. Those things are to be reported to the interim committees for the legislative finance and revenue stabilization. But those reporting requirements are very broad, if not vague, and in terms of accountability, it's really unclear if this information could be used for a proper analysis of the credit. The bill was not vetted. It was not discussed during any interim committees or with legislative staff prior to introduction. And it included no expiration date, and the fiscal impact report stated some very significant concerns with the effectiveness and the efficiency of this particular bill. For example, it would be really difficult for employers to know up front if their job candidates are qualified foster youth without violating some significant confidentiality concerns. And therefore, if the employer can't know up front or may not know up front if the person they are interviewing is a qualified foster youth, then it may not actually impact hiring decisions. So if it's intended to incentivize employment of foster youth, the credit may not do so. And it's also possible that employers may learn after already hiring someone that the person they've hired is a qualified foster youth and claim the credit after the fact, which would really not do a great job in terms of incentivizing employment of the foster youth. And since the credit could only be claimed for 1 year, it would also not incentivize the continued employment of that particular foster youth. So these concerns were expressed in the fiscal impact report and made available on the easy visual, but in the end, those issues ended up not coming up in debate, and the bill passed the Senate unanimously and passed the House with only 2 opposed, and it was signed into law. The last example I'll go over briefly is our rural health practitioner tax credit. Changes were made in the 2019 session to expand the types of healthcare practitioners that were eligible for this credit, and it had an estimated annual cost of about $8 to $11 million. The bill did not have a stated purpose, but that purpose was fairly evident to incentivize or to encourage healthcare practitioners to either locate or remain located in rural areas. It was unclear at the time if the bill had been vetted, and the original legislation and the changes made in 2019 did not have any required reporting. However, after some discussion, they did add a sunset date. The bill was later amended in our House Tax Committee after discussion specifically on the tax policy principles, where there was a request to add an expiration date in order to allow for continued review of the credit. We also noted that it was unclear if the credit really provides an incentive to stay in rural areas, and noted that it's likely the size of the credit is unlikely to incentivize healthcare practitioners to move to rural areas. In the end, our legislature did not fully pass this piece of legislation. It passed the House unanimously, but did not advance in the Senate. So, in all, our creation of the tax policy principles has been a mixed bag of some of the results. There was some opposition to adding purpose statements to legislation in general. This was more of a concern by our bill drafters than by the legislators. Our bill drafters feel that, at best, purpose statements are redundant and that the Act itself should lend credence to the purpose. And our drafters feel that, at worst, purpose statements could conflict with or set a standard that's inconsistent with the remainder of the Act, or it could lead courts to interpret the Act more broadly or narrowly than was ever intended, or the purpose could become obsolete over time. Despite that, it is still part of our official recommendations. We believe that purpose statements have a lot of value, particularly in economic development incentives, and our bill drafters will add purpose statements specifically to economic development incentives for any proposed legislation. However, none of the ones added included any long-term goals or measurable targets, so that's still something we're working on and trying to get introduced into legislation when there are proposals to add or change tax expenditures. Additionally, our generic reporting language, which only includes the annual cost in an aggregate way and the number of claimants, total number of claimants, it may not really be sufficient to determine the effectiveness or efficiency or any progress towards targets. And so we do need to do some work on expanding the reporting language and ensuring that what is required to be reported is actually going to be helpful in the public analysis of the expenditure. And then in general, we've had difficulty determining the effectiveness and efficiency for most tax expenditures. So when they're rated on the fiscal impact report on whether or not that expenditure is effective or efficient, particularly for existing expenditures that may be expanded or changed or extended, we really have limited data availability. There's not a lot of data on job creation or capital investment or economic impact currently collected. And a lot of that has to do with issues of confidentiality rules, and some of it has to do simply with us not requiring that, so that's hopefully something we can change in the future. But in terms of evaluating them now, we do encounter difficulties with data availability and also difficulties determining whether or not incentives actually influence behavior. But on the plus side, the 2019 session did demonstrate more awareness and more discussion of the policy principles when debating any tax incentive proposals, and particularly with an added focus on reporting requirements, albeit generic but still included, and on adding expiration dates. So most proposals for tax incentives in the most recent session either included these reporting requirements or expiration dates up front, or they were added later by amendment. And additionally, we've seen increased interest by our executive branch in having tax incentive proposals vetted by legislative committees in advance. And this really allows for us to get a better feel for what's being proposed and to include that in our fiscal impact reports, and it aids the review process and allows sufficient time for analysis. Our next steps are really to continue to inform our legislators of the policy principles and how to find them in the fiscal impact analysis. And there was a bill introduced in the 2019 legislative session that would have required our tax department to continue developing its annual tax expenditure report, which now is only a requirement through executive order but not by statute, and has not been released in the last 2 years. So this legislation would have required that to continue. And it also would have allowed our staff economists, certain staff economists, to obtain very specific confidential data that's held by the Tax Economic Development and Workforce Solutions Department, which would help analyze the tax expenditures available. And it would have provided funding for additional staff economists at LFC and software for dynamic modeling of tax incentives. Although this bill did not pass in the 2019 session, it may be introduced in future sessions. And with that, I will turn it over to Khara.
Thank you, Dawn and Jeff. We have about 10 minutes left for questions, and I'm going to try to answer as many that have come in and maybe try to group some of the ones together that thematically make sense. So first we have, I guess for both of you, what has the reception been from both policymakers and the public in your states to incorporating this type of upfront analysis?
This is Jeff. I think overall it's been positive. I mean, the tax preference performance statements are essentially just very detailed statements of intent, and obviously, tax incentives are intended to achieve a specific public policy objective. And so in this case, it's, related to certain economic benefits, and I think the legislators want to see those economic benefits actually materialize. So overall, I think they've been received, pretty well.
Thanks, Jeff. And this is Dawn here. And in New Mexico, as I discussed a little bit on the last slides, we've had overall some positive receptiveness from legislators and an increased focus on it. We have experienced some pushback on specific pieces of the policy principles, but in general, there's consensus within our Finance Committee that those policy principles should be adhered to, and increased interest by our Revenue Stabilizations Committee in focusing on those principles and the adherence to those principles when they review legislation during the interim. And there was an increased focus during the sessions in our House and Senate Finance and Tax Committees at looking at those principles and making sure that they are mostly adhered to, although there's more focus on the reporting requirements and expiration dates, things that are easily fixed. We're still working on ensuring a better focus on the issues of effectiveness and efficiency and targeting.
Great. I think we have a couple of questions related to that kind of get at the but-for question. So how have your states found ways to restrict the applicability of a preference to economic actors that would have invested absent the expenditure? And if that's something that has not been explored, are there ways that the cost that you have explored quantifying the cost of providing the expenditure to induced actors, as opposed to those who would have taken the induced action anyway?
So this is Jeff again. In Washington, that is a fundamental question. As I alluded to in my remarks, often the answer to that is unknowable. Whether the causation, and whether the tax incentive is actually a material factor in their decision-making process. I think as a proxy for that, that's where building in the specific economic outcomes essentially sort of acts in lieu of that, and then having the tax incentive up for reconsideration after a period of time, and where JLARC can review it and to see how it's worked overall. But yeah, it is very difficult to know whether the tax preference in and of itself is a material consideration in their decision making.
Thanks, Khara. This is Dawn here, and I have to agree with Jeff. We encounter the same difficulties in really getting at that but-for question, and the limited data availability that we already have only increases our difficulty in knowing whether or not companies would have taken that incentive anyway, or if it really it affected their decision to invest. And no, we haven't found a way to really limit the incentive itself to only those who would have done so, because it's difficult to really determine which of those would not make the investment but for that credit.
And I'll note, as I mentioned on one of the earlier slides where we look at the contextual data, that's where that's primarily what that part of the process is about, is trying to, provide some external data that would shed some light on whether, the tax preference is in fact going to have a material impact on their decision.
Okay. It looks like we have a question related to clawback components. Have you ever required companies to give money back? And have you ever repealed a credit because a company performance has failed?
This is Jeff. So we, I would have to double check to see if we have actually gone back to collect taxes that would have otherwise been owed from a clawback provision, because they are relatively, they're not very common in a lot of the tax incentive bills out here. We do, I have seen bills with expiration dates simply just not get extended. That does happen.
Okay. Don, did you have anything to add to that?
I have to, again, agree with Jeff. We rarely see clawback provisions included in a lot of our tax expenditures. Though I don't think it's entirely uncommon, I would have to double check on which ones include that. Though there are some incentives that do require clawbacks, but they're less common.
We do, just to add to that, we have a number of incentives for like sales tax deferrals, but for example, a sales tax exemption for a manufacturing facility created in a certain location, and there is technically, we do have other. They have a clawback where if the business changes the use of the property to something else other than the qualifying manufacturing activity, they have to pay back the taxes. However, in most cases, once they use the property for a certain amount of time, I think it's typically 8 years, then it just becomes a full exemption. And so beyond that 8-year period, they can potentially change the use of the property, and there would be no clawback at that point.
And I believe we have time for probably one more question. I know, Jeff, you spoke about this in your presentation as well, but does having an upfront process help in evaluating legislation later, and have there been any unintended consequences from implementing this process?
This is Dawn. The process is relatively new for us, so we have yet to see if there are unintended consequences of it. But the idea is that hopefully by having these tax expenditure policy principles available and attempting to incorporate them into any new or expanded tax incentives is what will allow us to evaluate them in the future. So the idea is that this would help us as we move forward in getting a better handle on our state's tax incentives, but that's really a question that remains to be seen for New Mexico.
Yeah, in Washington, it's been, quite an evolution over several decades where, I think the economic development type tax incentives started to become more common in the 1990s, and they would include these general statements of intent, but then they weren't very descriptive, and there was no process in place to actually, review the effectiveness of the program, and then in 2006 is when the JLARC, the process was created to review essentially all tax preferences, but then after a couple of years of that, then more issues emerged from that part of the process, where if there was intent language, it wasn't specific enough, or there was no data available. So then, in 2013, additional legislation was passed that required these very, very specific tax preference performance statements. And in terms of unintended consequences from this, the 2013 legislation, I would probably say the biggest challenge has been just making sure that well-crafted tax preference performance statements are drafted, so it creates a meaningful evaluation process. And because they do, I mean, to do it properly, it does add a substantial amount of time to the drafting process to go through, and oftentimes it requires a lot of additional analysis in terms of how the industry operates to get the metrics correct in terms of how to properly evaluate the program.
Okay, great. Thank you, Dawn and Jeff, and I will turn it back over to Emily.
Great, thank you. Well, this brings us to the conclusion of our webinar. If you have any questions following the event, please feel free to contact us at the email address shown. The webinar will be, or has been recorded and will be archived on the NCSL website. And lastly, please take a moment to share your feedback. We'd love to hear it by taking the short survey after it concludes. And thank you very much to our partners at Pew, our speakers Jeff and Dawn, and a big thanks to our audience for your interest and participation today. Have a great day.